Very respected speakers of this evening, Advocate Ms. Ankita Singh and Advocate Shubham Patel, Secretary of SIRC Panaraj sir, members of this great profession, a very good evening to all of you. I am extremely happy to have the third day of successful program on startup from setup to exit for the benefit of young members. I hope you would have enjoyed the last 2 days session and the way in which we have received the feedback from members, encouraging us to organize one more exclusive workshop on this particular topic. I request every one of you to continue to attend all the programs and send your valuable feedback so that we will do best out of best programs in days to come. Today we have with us two excellent speakers to share their knowledge among the viewers on the topic of term sheets and shareholder agreements, startup in black and white. On behalf of members of this entire region, I welcome Advocate Ankita Singh and Advocate Shubham Patel from New Delhi to this seminar, and thank them for accepting our invitation and addressing us in spite of this COVID pandemic. I hope today also we will get one more interesting and lively session. On this good occasion, I welcome each one of the participants for this evening interesting session, and thank you for your continued support for all the programs of SIRC. Before into the technical topic, now I request C. Panaraj sir to formally introduce the speakers for the benefit of the viewers.
Thank you, Chairman, for setting the tone for the day. And I take the privilege of introducing the speakers, both are advocates practicing at Delhi. Ankita madam brings with her a rich experience of having worked with leading law firms as well as leading the legal team of Indian Angel Network, IAN, Asia's largest angel group with more than 450 HNI investors. While at IAN, Ankita was responsible for end-to-end closing of the deals. She played a pivotal role in handholding the startups in further raising funds and supporting the investors to get the right value of money. Prior to IAN, she has worked in law firms and gained extensive experience in advising clients on investment, restructuring transactions, mergers and acquisitions, joint ventures, exit transactions, company formation, debt transactions, and company law matters. She has also worked with some of the IT juggernauts and the government together in the UIDAI project, colloquially Aadhaar. Ankita's experience includes advising clients across sectors including telecommunications, information technology, renewable energy, power, manufacturing, hospitality, food and real estate. Ankita is practicing as lawyer since 2011 and a qualified company secretary also. Welcome once again, madam. Now I take the privilege of introducing Shubham Patel, another senior associate. He's an ardent learner who has pursued his BA LLB honors degree from Jindal Global Law School. He's an associate at the same firm. His area of interest revolves around startups, general corporate, and private equity. Having worked on a mini business idea from a whiteboard to a revenue marketing initiative, he is most empathetic to understand a client's queries and needs. Shubham practices in core areas of commercial law and entails customized assistance to clients in drafting shareholders agreement, founder agreement, service agreement, detailed ESOP policy, privacy policy. Shubham firmly believes in integrity in the workplace and aspires to dedicate meaningful work hours to meet the high aspirations of the clients. He always looks forward to work with motivated individuals from diverse backgrounds on challenging fronts. With strong research-based internship experiences from various firms of all scales, he has gained a wide knowledge base to provide support to the team. With this introduction, I present both the speakers to the audience. Over to you, Madam.
Thank you so much, sir.
Please, Madam, please unmute your mic.
Yeah, thank you so much, sir. Thank you so much, Jalpati sir and Pannaraj sir. It's a pleasure to be here, and we would like to, provide to our audience and make them aware of our experiences, which we have gone through in our, career of advising the startups and the investors in this investment ecosystem. And I am hopeful that it will be quite interesting for everyone here. I would request Shubham to, So this session is particularly on the term sheet and the shareholders agreement. To give you a background on ourselves, which Mr. Pannaraj sir has already given, but I would like to also let you know that we are both of us work together in this firm, Sarvank Associates, and our clientele includes the startups predominantly, as well as the investors and PE funds. Shubham, if you can just scroll. So I would request Shubham to give you a brief on what first 3 slides are about. Then we would come to, the term sheet essentials and also the shareholders agreement.
So, hello everyone. A lot of people have joined in. It's really great to be speaking here. Hope through this session we can give you some, nice information, inside information about how we conduct these businesses, these transactions at a law firm level, and we can both learn something. So, starting with the presentation, just a simple disclaimer: whatever we are talking about in terms of the rights and obligations in this and how they are negotiated in the term sheet or in the shareholders agreement, these are all being discussed in a general scenario. In case there are special circumstances, always these things need professional help. So if you're actually looking to work on a transaction, definitely look forward to engaging a lawyer who can give you a personalized legal solution on this. Now talking about term sheet and SHA, right? They are part of an investment journey. Now, what does that investment journey in an oversimplified version looks like? It looks something like this. The first step of any startup is to prepare a pitch deck, which they generally pitch to investors. Once the investors and the founders sit down, negotiate the deals, and are ready to do an investment deal into the startup, a term sheet is signed. The term sheet basically outlines all the major terms that will govern the transaction, and also the investors stay in the company as the shareholder till the point the investor leaves the company with an exit and making certain profit that they were envisioning to do, right? Once the term sheet is signed, there are due diligences conducted in which we look at the background of the company, the operations of the company, ensure what has been done till now is all in compliance with applicable law. If there is any issue, then those issues are highlighted. If there are some major risks, they could also lead to renegotiation of the commercials of the deal as well. Post due diligence, you generally prepare the transaction documents, the shareholders agreement, the share subscription agreement, or sometimes these two agreements are combined together into a share subscription and shareholders agreement. Right? The last part, when these agreements are finally signed, we lead to the actual funding of the investment. Okay? So we are gonna today learn about what the terms are covered in the term sheet and the SHA, right? Thankfully, we are doing this session where we are examining the term sheet and SHA together because there's a great overlap between the two. A term sheet is essentially a shorter version to record all the terms that will go eventually into a shareholders agreement. There are certain, minute characteristic differences in a term sheet and an SHA which differentiate them. The term sheet is generally signed at the very beginning. This is at the point where the investor has believed everything that the founder has told to them about the startup, and based on that, they are entering into this soft deal, to say, which is not actually legally enforceable, to do an investment transaction. Because the reason it is kept not to be legally enforceable, because the nitty-gritties of these deals might change, and even the deal might fall through if some issues arise during due diligence or further negotiations, right? Therefore, this is not legally enforceable document. There are only 3 items in a term sheet that are kept enforceable, which are the last 3 items you see in this cluster of all the terms: exclusivity, confidentiality, and governing law. And what these terms are essentially, the founder and the investor have negotiated certain terms and they are okay to invest into the company subject to the due diligence. But the investor would want to say that now that we are agreeing to invest in the company, please don't go right now and solicit other offers, because all the exercise that I will do from here, from the signing of the term sheet, the due diligence and the framing of the documents, will all be a waste for me, a loss for me if you keep looking for better deals out there. And therefore, let's agree to a period within which we'll look to complete this deal, within which neither the company will not go and find other investors to invest in the company. So they request such an exclusivity. The second is the confidential nature. A lot of these times, investment houses and would want to keep the confidentiality of the term sheet intact, because they would not want other parties to know what offer they have made to you, and they would want to impose this confidentiality you as well. So that is why confidentiality is generally kept. The last is the governing law. In the event exclusivity or confidentiality is broken, where and which court will we go for resolving our dispute? So that is specified in governing law. Essentially, in a whole term sheet, only these three terms are legally enforceable. The rest, all terms in a term sheet are just smaller versions, briefer versions of the terms that will go into a shareholders agreement. One of the most essential things that come into a term sheet are the cap tables. A cap table gives you a perfect gist of the transaction in the financial terms. It will tell you what the shareholding of the company is on the day before the investor comes into the picture and invests into the company. It will show you the shareholding that will be created once the investor invests the money. And if there are different tranches within which the investment is coming, you will also cover a cap table for covering the last tranche of the investment as well. On every tranche, how the cap table is changing will be reflected in the term sheet. They form as an annexure of the term sheet. Right? This is what a normal cap table would look like. You will specify the shareholders, what class of shares they are holding, equity, series A1, series A2, what the actual number of equity shares will be allotted in front of the compulsorily convertible shares, that is specified, and what is the percentage shareholding on a fully diluted basis. That is what this refers to. This is what the cap table would look like in a term sheet. Now we have broken down all these terms into certain categories, and we will try to explain those terms based on which category they are falling in, because they are designed for a specific function that the investor or the founder is looking for. First are the purely monetary terms. These cover just the commercial nature of what is going to take place in this transaction, right? So the first thing you would want to specify in a term sheet is what instrument is being used to make that investment. Are equity shares being issued? Are debentures being issued? Are compulsorily convertible preference shares being issued? You need to specify what is the instrument that is going into the company. Second is the valuation at which the investment is happening. That is very essential from perspective of compliances as well as commercial perspective, because that is how you will calculate what your returns are, right? A pre-money valuation is basically the valuation of the company before the investor has come into the company and decided to invest. So let's assume throughout the whole thing that we're looking for a pre-money valuation of 10 crores, right? The investor comes in and invests 2 more crores. Therefore, your post-money valuation, basically the valuation after the investment, will become 12 crores. Right? Investment amount and shareholding. What is the investment amount? Rupees 2 crores in this transaction that we're looking at example. And what is the shareholding that I'm getting in the company? This will determine what the overall valuation also works out. Right? What specific shares? If I'm investing around 2 crores in a 10 crore valuation, I'm getting somewhere around 20%. Right? Director and officers insurance. This is an expenditure. Right? So since we are covering monetary terms, we are covering terms which cover a flow of any money happening in the transaction. Directors and officers insurance is generally what an investor would request when they themselves are putting a director on the board of the company, because they essentially believe, and this is generally how a startup works, is that the founders are essentially the people who are in control, responsible for the day-to-day functioning of the company. The investors are bringing in money, and they want to provide other additional structural support to the startup so that they can grow. Right? In that perspective, when they place a director on the board, they are not essentially looking for the director to do any kind of specific work for the company with respect to looking over its compliances, because they don't want to take the power from the founders and let it be the responsibility of the founders. Therefore, in the event any compliances are found absent in the company, there is any issue, there is any notices that come up, you would want that the investor would want that the investor's directors is insured against this. as a general rule nowadays, the investor would be okay with even the founder directors taking themselves insurance, which is completely fine. That is something you can negotiate on behalf of the founders, that they themselves as directors should also be getting insurance. The last is transaction expenses. What expenses are being incurred by the parties to complete this transaction? In India, generally the standard is that the startup pays for two sets of people. One is the investor's lawyer who frame the document, who frame the transaction documents, who conduct the due diligence for the investor, and also the company's own lawyers who would negotiate on those documents and help the company go through the process of due diligence. Both the expenses are generally borne by the company. Here, what you could look in perspective from the founder is to put a limit on the amount that the investor will incur to pay to the lawyers, because you would not want that amount to be not restricted, because that could lead to a great expense on the company. So generally, you always put a limit on these transaction expenses, about an upper limit at least. Right? Now coming to investor rights, we have divided investor rights into two portions. Both portions will be covered by Ankita. One is investment-based rights, that is these rights are being taken by the investor because of what investment they're conducting, and the other is governing-based rights. These rights they take to ensure proper governance from their end to on the company. Right? Over to you.
Yeah, thanks, Shubham. So, based upon the investment of the investor into the company or into the startup, the investor is provided with certain investment-based rights, which depends upon the quantum and the amount of investment and the valuation at which they are bringing. Since the investor is the financial investor into the company, and therefore, and they are helping in the company to, progress further and to meet all the milestones which they must have thought about for themselves. We provide, or we tend to provide to the investors certain rights which are actually, to protect the investors from any downside and to protect the investments made by the investor. So that's why these are known as investment-based rights of the investors. Now, to give you a sense of what these rights are, I would take these rights one by one and try to explain you on how and these rights are negotiated, why it is beneficial for the startup, why it is beneficial for the company, and what and to what extent these rights can be negotiated by the startup or the the founders or the investors. Since this, as the name suggests, the exit rights is one of the important aspects which investor would ask whenever the investor is investing into the company. And if you will see the exit rights, as the name suggests, is also with respect to how the company and the investment will be, will be returned to how the investment made by the investors will be returned back, and at what will be the percentage increase on the investment which will be made by the company. So whenever the investor is investing into the company, there is a contract that a minimum of 5 years is what the investor looks as an exit option to exit their investment from the company. 5 years, because 5 years is an ample amount of time wherein the company should progress to an extent that it is able to provide the exit to the investors. Now, there are certain mechanisms by which the exits are provided to the investors, which is already provided here. It is buyback, it is IPO, it is business transfer, or it is drag along. Now, if I talk to you about the initial, exit right which the investor looks at, is the qualified initial public offering. Everybody must be knowing here what the initial public offering is. The investor always wants the company to, attain that much of success and to reach to a point where the company can move towards an IPO. That's the first mechanism which the investor would want, to liquidate their investment and to get a final return on that. The next, and this is after, the minimum period of 5 years as per the term sheet. Now, the other mechanism, if the IPO doesn't happen, the other mechanism can be the business transfer or the strategic sale, which is not mentioned here, but strategic sale and the business transfer are two mechanisms which are also looked at for, liquidating the investment. Strategic sale is where a strategic investor purchases the investment of the existing investors, the investors or the founders maybe, and also the business transfer wherein the entire business is being transferred to that particular, third party. That is one of the mechanisms wherein the exit is being obtained by the investors. Then, as I told you, that 5 years is a minimum period which is provided to the founders and the company to provide the exit to the investors. Say in the case where after the 5 years period, the exit is not being provided to the investor also has the right to ask the company or to force the promoters to provide them exit through the buyback of the shares of the investor. So what happens is that the investor provides the ample amount of time, which is post 5 years. Normal negotiation is that after all these, exit rights are not being applicable on the company, or they are not able to provide taking these exit rights into consideration, the 6th year or the 7th year is when the investor will force the company to, or the founders to provide them an exit through other mechanisms which are there, under the law. One of those aspects are buyback. Buyback is under the Companies Act 2013, wherein the company is required to purchase the shares of the investor at a fair market value. Now, the process of buyback is already provided under the law, and it has certain restrictions in itself, wherein 25% of the share capital is not, more than 25% is not bought back at one point of time, and 10% of the equity capital is not bought back, at one point of time. And there has to be a minimum gap of 1 year between two buybacks. So this is one of the rights which is made applicable to be provided to the investors at the time where they are not able to exercise their exit right to any other mechanism. The most onerous exit right or exit right which is not actually looked at with a very fair point of view is the drag along right. So drag along, as the name suggests, is when the investor drags the shares held by the founders and also at times the existing investors. Now what happens is drag is normally negotiated as the last option which is made available to the investor when all the other options are not fulfilled, or the company or the founders are not in a position to to provide the exit to the investors by making available any other exit mechanism. So the drag is normally negotiated when maybe the 7th year or the 8th year, that will depend upon the negotiation between the company and the investor, but it is the last option. And in this case, the investor would force the founders to sell the shares along with them to a third party. Now what happens? It is a downside protection for the investor. When nothing is made applicable, when there is nothing left in the company, there is only one option wherein any strategic investor or any investor who wants to control the company would be intending to buy that company. Now, since any investor who would want to have the majority shareholding would only be intending to buy the company or the shares, they would want to get the majority shares. Now, the investors are always in the minority, holding around 15%, 20%, or 25%. But in order to give them the majority shareholding to the third party, there has to be a mechanism wherein forcibly the founders are required to sell the shares to that third party, and that is known as the drag along rights in the hands of the investor. Now, this is normally, with respect to exit rights, there is one thing which is also applicable. It is, and in fact, not only exit, for any other, rights also, that whenever there is a new round of investment or a successive round of investment after the initial round, all these rights are settled. So if in, say, investment happening today or the term sheet signed today, the exit rights are made applicable from the 5 years of the date of signing of the SHA. The next round of investment, whenever it comes in, the exit period will be reset. So what happens is, it rarely happens that drag along is being triggered by the investor, because the exit rights are again reset. So say after 1 year, if there is an investment happening again and the SHA is signed, so for all the investors, the exit right will be from the signing of the SHA of that particular investment. So, the 5 years period will again start from that point of time. So that's how the investors are also safe. And because the investments are happening, it means the company is growing and investors are happy and the company and the founders are fine. The second is the liquidity preference. Now, liquidity preference is, as the name suggests again, it is when the investment of the investors is being liquidated. How that happened is the liquidity event is defined whenever there's an acquisition or a winding up or a merger of the company, wherever the cash of the investors is being returned to the investors, or any such event which helps in cashing the investment made by the investors. That is known as the liquidity event. What happens whenever this kind of a situation happens? Say if there is an acquisition offer of the company. The investment made by the investors will be liquidated based upon the proposal of the incoming investor or the acquirer. And then, whatever the amount is received will be divided as per the liquidity preference, which must be there in the FHA signed with the existing investors of the company. As the name suggests, there is a waterfall mechanism. Waterfall mechanism is how the liquidity preference will be ascertained. The investors, the new investors, say if there are the newest set of investors which must have invested, a month back, then there might be existing investors who must have invested, say, 1 year back, and then there are founders or the advisors and the founders. So this is how the categories are defined. So in the normal scenario, the newest investor will have the first right to get their liquidation, get their money in this kind of a liquidation event. Then the existing investors, followed by the other shareholders, if any, and then the last one will be the promoters. What will be the calculation of this, the liquidity event and the encashing of the money? Normal scenarios entail that there is participatory liquidation preference, there is non-participatory liquidation preference. And this is a complete negotiation happens on the table whenever these kind of deals are being signed. Now, participating liquidation preference is when the investor negotiates to participate in the proceeds of the company after liquidating their investment amount. So if an investor has invested 10 crores and there is a 20 crore or say 200 crores liquidation money which is coming in that kind of liquidation event, so they will get their liquidation, their investment amount which they have invested, that is 10 crores. And if they are holding 20% of the company, they will also participate in the remainder liquidation proceed, and they will get 20% of the remainder liquidation proceed. Now, this is known as double dip, or participating twice into the proceeds of the company. So that's something which is avoidable, also not only from the sense of the founders and the company, but also from the, when it comes to the investors as well. Because what happens is that, if there is a trend of agreeing on a participating liquidation preference, and there is an further investment which is happening, the next round of investor will also ask for the same set of rights which must have been given to the existing set of investors. Now, if the next round of investor or the newest investors also have the participating liquidation preference, what happens is the remainder will be lesser, for distribution to the existing investors also and to the founders also. So in order to safeguard the downside of the investors, there is a term known as non-participatory liquidation preference, wherein the investor will get the amount invested by the investor or the percentage holding on the proceeds of the company, whichever is higher. By being whichever is higher, it will also protect the downside of the investor. So I think, this is the more appropriate mechanism to negotiate the liquidation preference. It not only protects the founders, it also protects the existing investors and the set of investors as well, and everybody will have a fair pie in whenever there's a liquidation event happening. The third very important right for the investors is the anti-dilution right. So anti-dilution means to protect the investors from the dilution, as the name suggests. Again, say if there is a round of investment happening at 20 crores right now, and we are negotiating a term sheet based upon 20 crores of investment, 20 crores valuation. After 1 year, now every investor is investing basis that the company will grow and there will be an upside in their investment. However, you don't know what the policies will be, you don't know what the market will be. Like, for example, we are right now struck by COVID-19, and there are certain business houses which are very badly impacted by COVID. So nobody has seen the future. The business might go south, and there might be a situation wherein the investment is being raised at a later point of time at a valuation which is even lesser than the first round of valuation. That is maybe 15 crores or maybe 20 crores. In that scenario, whatever the dilution is happening for the existing investors, and if they are having an anti-dilution right, the company will make sure that the amount of dilution which is happening because of the lower amount of lower valuation, lower valued round, will be the extra shares to that extent will be provided to the existing investors so that they maintain their shareholding in the company. It can happen through different ways. It can happen through new round of new set of shares being allotted to them at a minimal price, that is a nominal value, or there can be a transfer of shares from the founders. There can be different mechanism of allotting them the new shares so that they are able to maintain their percentage shareholding into the company, and that is what is known as the anti-dilution. The fourth one is the preemptive right. Now, every now and then there is a new investment in the company, and that is how the company grows. Because if there is a first round of investment, the 2 crore of, if say the company has obtained 2 crore of investment from the investors, that 2 crore is depending upon the business plan of the company. Now, after say 1 year, that 2 crores is exhausted, and the company is looking for the next round also. The company will be required to give a right to the existing set of investors under the preemptive right mechanism. So the investors will ask for the preemptive right to invest into the company whenever there will be a next round of investment. It will save them from maintaining it will save them from diluting themselves. If the company is growing very well, they would definitely want to invest into the company more. They might want to invest into the company on a pro rata basis to maintain their shareholding, or they might have the super preemptive right, wherein they might also want to invest more than what their right is on a pro rata basis. So if they have a 10% of right in the 10% of investment into the company, if there is a next round of investment, which and the investor, the third party is keen to invest 100 crores in the company, and the company is keen to get those 100 crores. So 10% of that particular investment amount is the right, preemptive right, which will be provided to the existing set of investors. And if some of the investors who hold the preemptive right are not keen to get, invest into the company, the other investors are also, can also take those particular rights and can invest into the company and maintain their shareholding, or even maintain their shareholding much more than what the existing shareholding was there. Now we are coming here to the investor right to transfer the shares. So normally investors right to transfer, investors are allowed to freely transfer the shares into the company, which they hold in the company, except to the competitors. The restriction on transferring the shares to the competitor also falls away when the exit period is starting. So if say after 5 years the exit is not being provided to the investors, so the restriction on the investor right to transfer to the competitor will also fall away, and they will all have all the right to transfer the shares to the competitor. And normally it happens in the drag along, because obviously some of the competitors will only be keen to invest into the company and hold the majority shareholding, right? So the investors right to transfer to the competitor will kick in once the exit is not being provided to the investor and the exit period is exhausted. Otherwise, they have the right to freely transfer the shares. Apart from that, right of first refusal. So this right of first refusal, right of first offer, tag along rights. These are the 3 rights which we are also discussing in the next slide. Shubham, if you can just scroll to the next slide. So this we are also, the right of first refusal is also known as right of ROFR. Right of first offer is known as ROFO, and tag is the tag along right. So these are the nomenclatures which is used in the term sheets and the FHA, on the normal common parlance. Now, if I talk about what is right of first refusal, Shubham, if you can come to the previous slide. Yeah. So these are, the right of first refusal is the right which is being provided to the right holder, wherein if any of the existing investor or the founder specifically is selling their shares, the investors will have a right to purchase those shares. Now there is a difference between right of first refusal and right of first offer. What right of first refusal says that the founder will have to get a third party offer in order to sell the shares. So if the founder is keen to sell the shares, they will have to get to the third party, have a definite offer from them to purchase the shares, and then they will have to come back to the right holder, that is the investor, and provide them an opportunity to purchase those shares on the same terms and conditions that is mentioned in that third party offer. So if the current investor or the right holder is intending to purchase those shares of the founder, there is a specific time period wherein they have to say either yes or no. And if they are going ahead to purchase those shares, there is again a specific time period in which they will have to fulfill that commitment. If they are not keen to purchase those shares, then the founder or the existing investor who had gone, who has bought this offer, will have all the right to sell the shares to that third party, but not more than the value at which their offer was there. So this is the right of first refusal. Now, right of first offer is where the right holder, the founder or the existing investor will have to come to the right holder first, rather than going to the third party. They'll have to come to the right holder whenever they want to sell their shares, and they will have to ask them and tell them that we are selling 100 shares which are owned by them, and what will be the offer from the right holder side to purchase those shares. So in this case, the price discovery is made by the right holder and not any third party. So that the seller will have to first come to the right holder, and if the offer made by the right holder is acceptable to the seller, that is the founder or the existing investor, they will sell those shares to that particular right holder. If not, then they will go to the third party and sell their shares at a value which is higher than the value at which the right holder has proposed to purchase the shares. Now, if you see, there is a difference between the ROFR and ROFO. The ROFR always requires a third party offer to proceed, while the ROFO does not require any third party. And the first instance at which the offer will happen is from the right holder and not any third party. Commonly, what happens is that the right holder or the investor would want to negotiate for ROFR. The founders would want to negotiate for ROFO, because whenever there is a third party involved, then it makes very difficult for the seller to actually sell the shares. Because if there is a ROFO and if the founder is going to a third party that, I want to sell my 100 shares, what will be the offer? Your third party will always require, what are the restrictions on these shares. And if there is a ROFR, they would know that this is a price discovery mechanism, which is used by the right holder to find out what is the exact valuation of those shares in the market. And what normally happens is whenever there is such ROFR sale happening, the third party is knowing that, I will, make all the attempts and find out the valuation of the company and find out the valuation of the shares. I'll make an offer, make all the efforts, and then this seller will go and offer make this offer to the right holder, and the right holder will intend to purchase those shares. So it makes it difficult for the seller to sell the shares with the ROFR attached to it, while it is always easy for the founder to go ahead and offer the shares to the investor or the right holder and get a price from them. And if they are not interested, then they can go and sell it outside. So ROFO is an easy mechanism. ROFR, it makes a bit difficult, and that is why ROFR is preferred by the investors, while ROFO is preferred by the founders. But in the initial negotiations, ROFR is what is agreed upon by the founders also. So tag along right. So tag along right is when there is a mechanism, there is a ROFR and ROFO mechanism happen, and the shares are not being purchased by the right holder. and are being sold to the third party. The right holder holding the tag along right will have a right to sell the shares along with the seller. So if there is a founder who is selling the shares, the ROFR or ROFO, whatever restriction is there on those shares, the process is being followed, and the sale is not happening to the right holder, they will go and sell it to the third party. Now, if an investor or the tag along right holder is have the right to force the seller to sell those shares on a pro rata basis if it is less than 50% of the shares being sold to the third party. Now, this is because every investor would require the founder to have skin in the game. Okay, they would want the founder to be in the company because that is how, and based upon the founder's capacities and expertise only, they have invested into the company. So no investor would want the founder to dilute their shareholding into the company. So whenever the founder is selling the shares to a third party, and if the sale normal this is the percentage that is 50% or 25% is the normal course of negotiation, whatever they have agreed with. If there is a 50%, say if I take an example of if a founder is holding 200 shares and if they are selling say 101 shares to a third party, the right holder, the tag along right holder will have a right to sell all their shares along with the founder and exit the company. And this sale of the right holder will be happening at a priority to the founder. So the founder will have to make sure that the investor shares are being purchased by the third party. And if the shareholders, if the seller is selling less than 100 shares, say they are holding 200 shares and they are selling 50 shares, then the sale by the right holder will be on a pro rata basis. That is, they will be required to sell, or they will be they have the right to sell their shareholding on a pro rata basis if the sale is happening, which is 50%, less than 50% of the shares held by the founders. Now, no superior rights is the rights, as the name suggests, it says that at the same valuation, if there is a round happening, there will be no superior rights which will be given to a third party investor. So if say ABC Limited is investing into the company and the valuation is the same in which the last round investor has invested, so no superior rights will be given to that particular incoming investor. And if at all it is being given to the incoming investor, all those rights will be made applicable to the existing investor as well. So these were the investment-based rights, which were applicable and which are given to the investors in a normal PE equity deals. And, it is from if I say there are different series of investments which happens, there is an angel round, which is around 2 to 4 crores. There is a series A round, which is a bigger set of round which happens. And these set of rights are very commonly seen in these kind of investments. Shubham, let's move to the next one. The next one, this slide, which we have already explained. Now, there are certain rights which are based on the governance mechanism of the company. Now, if the investor is investing into the company, we always know that the founders are responsible for the operations of the company. The investors who are investing into the company for growth is the financial investor, and they all have the minority investment into the company and hold minority shareholding of the company. Now, they have to have certain rights which will provide them an ear and eye to be in the company and to see how the operations of the company are being dealt with, and to see if there is, everything is being dealt in a fair manner, and the finance and the expenses and the mechanisms are being followed under the law, under the tax, all the tax returns and all are being, fulfilled at the right point of time. So all of these aspects are being seen into the company, and these are the rights which are made applicable to the investor, which entail a kind of governance mechanism into the company for the investor. Now, talking about the board structure. So we all know that a startup or a company, which is a registered company, normally as a private limited company, has a right to appoint the directors, and a minimum two directors are required for the company to function. Now, the directors have the fiduciary responsibility for the operations of the company. The investors who are investing into the company generally negotiate for a board position, and the board position would definitely mean the director position on the board of the company. The other mechanism wherein the representation of the investor on the board of the company is maintained is also by appointing an observer. Now, the director has a meaning under the Companies Act 2013, and there are certain statutory and mandatory obligations which are required to be fulfilled by the director, which is appointed on the board of the company. So the investor would require their representative to be on the board of the company in the form of a non-executive director. That is, he is not responsible for the day-to-day management of the company, but he will be required to be there in all the meetings, all the agendas and everything should be made available to them. And normally also they negotiate for their investor representative to be present in the quorum of the company, to maintain the quorum of the company. So the other mechanism by which the representation of the investors is being maintained into the company is by appointing an observer into the company. Now, observer is a contractual representation and is not a statutory representation in the Companies Act 2013. There is no law which actually prescribes that. There is no form which is filed, but there is a representative with which agreement is signed by the company, and their observer will be, and the agreement would entail that the observer will be required to attend all the meetings. The company will be obligated to give them all the agenda and everything well in advance, like it is being given to the directors of the company. They are required to be present into the meeting to maintain the quorum also, and also they will be provided the agenda and everything well in time, the minutes after the meeting well in time, and also they might give some inputs into the while the discussions are happening. However, the board is not required to mandatorily accept those inputs because that's not a statutory position under the law. So that is how these are the two mechanisms, that is the director on the board or the observer into the company through which the investors maintain their representation. Ideally, what happens is that whenever there is the company is at a nascent stage, or wherever there is an early stage of investment happening into the company, normally the investors look for a director to be appointed into the company rather than the observer, because the director has the larger capacity to work closely with the founders and not only be under a contractual obligation per se. The second set of governance right, which entails a very important aspect, is the reserve matters. Reserve matters is a list of matters which is reserved for the investors to provide a affirmative vote and provide a specific consent to be dealt with that matter. So if there are 20 to 25 or 10 to 15 matters in that list, which is very crucial for the company as well as the investor, which has an impact on the investment of the investors and also the prospects of the profitability, the marketability, of the business as well as the company. So if I give you some examples of these reserve matters, it will be if there is a creation of a subsidiary happening, if there is a hive off happening, if there is a split of shares happening, if there is a share swap happening, if there is a new set of directors being appointed into the company, if there are key managerial personnel appointed into the company, if there is an ESOP means the employee stock option, which will be dealt later on. Employee stock options is given to us employees at above a certain threshold. So all of these important aspects which particularly impacts the investment of the investors into the company are characterized as a reserve matter, and specific prior written consent of the investor or the representative of the investor is necessary to even take that matter into the meeting and discuss that. So reserve matters list will require the prior written approval of the investor or their representative for the matter to be tabled for discussion in any of the meeting, board meeting or shareholders meeting. The next set of right which investors have is the indemnification. Now, as Shubham has told earlier that there is a due diligence happening on the company by the investor. Normal due diligence mechanism, what entails is looking into the working or the way in which the operations were conducted by the company. It involves the legal, finances, as well as the tax diligence of the company. Now, the legal aspects might be the agreements, the statutory obligations of the company to file the annual returns, to file the forms once the directors are being appointed, to file the tax returns, to file the GST returns. All of these aspects are being looked upon at the time of diligence. There is a list of representation and warranty, which is made available by the company and the founders, and it can be severally or jointly, that all the operations are being conducted in a fair and transparent and diligent manner. So whatever information they have given at the time of diligence, whatever document they have given at the time of diligence is true and proper. These representation and warranties is connected with the indemnity. What it entails is that, and this indemnity, this representation and warranty holds true on the date of execution of the shareholders agreement, as well as on the day on which the investors are allotted shares. And if at a later point of time there is some gap or there is some breach or violation of these representation and warranty basis which the investors have invested into the company, and if the investors face any loss on account of that breach or any of the terms which were agreed in the SHA or the shareholders agreement, the investor has all the right to make good that loss. And that is what is known as indemnification. And in this case, the investor will ask for the indemnity from the founders or the company, whoever is responsible for this. Indemnification is normally capped. That is a negotiation which happens. It can be either unlimited, fair for the investors, or it can be capped, or it can be agreed to an extent basis upon the negotiation between the parties. In general, negotiations, the indemnity is always capped up to the investment amount. So if there is an investment amount happening of 2 crores, the indemnity will only be up to the amount of 2 crores and not more than 2 crores. The fourth set of right is the information and inspection right, and which is very clear from the name itself that the investors will have all the right to inspect the books of the company at intervals given in the term sheet or shareholders agreement, and they have all the right to ask for any information from the company, though in the form of monthly information system, MIS, or a quarterly MIS, whatever they are agreeing. There is an MIS which is agreed with the company and the investors. These are the specific items which we will require either monthly, quarterly, or in whatever way it's possible. And all of these information rights are provided into the term sheet and also further explained into the SHA. The inspection right is if the investor is feeling or having an apprehension on the operations of the company, they can very well appoint a representative and they can get the inspection done on the operations of the company and find out if there's something fishy happening or if there's some information which they require which they are not getting. They can very well get it inspected and get those information to the extent possible. Shubham? So I would request Shubham to take on the founder restrictions. There are certain restrictions applicable on the founders shareholding into the company, because like I said, the investors always want the founders to have skin in the game. They would definitely want the founders to be associated till their investment is being liquidated or they get the return on the investments. I would request Shubham to take these.
Yeah, right. So we looked at right now 2 sets of investor rights, right? One was based on them protecting the investment that was made into the company, and second was to ensure no functionality of the company can be used to dupe them of their money, right? So that's why they create those governing based rights as well, so that in the normal functioning, nothing goes haywire which can make them lose their money. Now we come onto the founder restrictions. As Ankita rightly pointed out, as an investor, when I'm investing in a startup or any VC fund coming in a startup, obviously there is a good impression about the business. There is certain interest in the business, but there is also considerable interest and backing towards the founder. A lot of times investments happen because who the founder is, because the ability of the founder to actually execute a certain idea in which the investor is now believing in, because of the manner the founder has projected the company and has promised to run the company and do something path breaking, right? Therefore, to ensure that the founder is always committed towards the company, they will put in certain restrictions or certain conditions to ensure that the founder has a skin in the game. One of those things is founder lock-in investing. Right? As an investor, I can ensure most primary way. I can ensure that the interest of the founder remains in the company by the founder continuously owning the shares in the company that he currently owns. Therefore, I would want to restrict him from transferring away his shares. I have one mechanism under right of first offer, right of first refusal, and tag along right. But those are when the transactions are actually taking place, when the founder is actually exiting and selling his shares, where I say, ki, okay, I will tag along with you, or no, you offer it first to me, something like that. But before that kicks in, I would want to restrict the founder's overall ability to access the shares. That would essentially mean putting the lock-in on a particular founder, saying that, for a, let's say if I'm in the company for a period of 5 years, generally an investor would start by putting a lock-in of 5 years, which is as per generally acceptable right now has come down to around 3 years. There's a vesting schedule that is prepared on which the shares are vested back to the founders and unlocked as per that particular schedule. Generally, a very reasonable schedule would be something that there is a certain portion which is completely unlocked from the first day. This is created to give emergency provision to the founders. Tomorrow, let's say the founder has a particular emergency situation because of which they need certain money, they want to sell the shares of the company. So you give 2, 5, 10% as an emergency unlocked shares. However, generally the investor would say, even on these unlocked, completely unlocked and unrestricted shares, please offer me a ROFO at least, because there, if you're in emergency, I would still be wanting to buy it and give you a good offer, right? And retain the control within the existing shareholders of the company. Past this unrestricted portion, the schedule would generally say 25% of the shares will unlock on the first anniversary of the investment, and the rest over a monthly period of within 2 years. So taking down the whole time to a certain amount of 3 years, within which all the shares will be unlocked. Keep in mind, post this lock-in period as well, the founder will still probably be bound by right of first offer or right of first refusal and tag, right? That will still exist, but that is coming post lock-in. The next portion is intellectual property rights. Now, as a founder of the company, when I started the company, generally what people do is they end up registering trademarks, patents, or any kind of intellectual property in their personal name. The investor would always want, and this is good for the company as well, to always register these intellectual property rights in the name of the company, because we are using the company as the actual vessel to run the whole business. And therefore, tomorrow, if the company does not own the trademark under which it is selling the product, it's a very big risk for any investor or anyone who's looking to further the business of the company. Therefore, all intellectual property rights that are created before the investment and are being used by the company or post the investment through the founders should always vest their ownership in the company. The next is non-compete and business exclusivity. Now, imagine if we do not have non-compete and business exclusivity, what essentially it would mean that is the founder tomorrow quits the company. He creates another company with all the technical know-how that he already has, which was basically the backbone of the current startup, and starts a competing entity. That creates a situation where the investor is now invested into an entity which is not functioning anymore because the founder has created a parallel entity which he 100% owns, and he has learned all the technical know-how from the current company, right? So you would want to say that even if the founder leaves the company, there should be a non-compete. Now, non-compete essentially is a very big topic altogether. The enforceability of non-compete on a person is very subject to what judicial cases have said. However, a maximum period that a judiciary generally agrees to is 2 to 3 years of non-compete. However, the restrictions should be very reasonable. And one of the essential things that court would look at non-compete is that whoever the non-compete is being enforced on, let's say the founders here, it should not be to an extent that they are not able to practice their main trade, right? If tomorrow writing codes and writing and creating mobile applications was what I was doing in my current startup, and I create another company to do a different kind of app and different kind of product, then I should be allowed to do that. You cannot restrict me from writing any more code for the next period of 3 years. That is not a reasonable restriction. A reasonable restriction will be not to create a product which is similar to the product that the current startup creates, right? Such a non-compete is very reasonable. So there are always nitty-gritties within these clauses. That's where the actual negotiation takes place, right? The second is business exclusivity. Till the time the founder is in the business, he is employed by the company, he should not be engaging in similar activities or any other activities in any other business which would take away their concentration from the current startup. Now, again, this is very subject to startup. You may have certain founders who are efficiently running already two existing startups, and now they have a third idea which they want to run. In which, if the investors have confidence in the founders, this could be relaxed for certain organizations to say that these are the existing businesses of the founders, they can continue doing it, but beyond this, no more. That kind of business exclusivity is also acceptable. So this is a conversation in which the founder themselves need to tell the investors what they're existingly doing and therefore create an exception for those. The next bit is founder employment agreement, which is very essential, and this agreement forms part of the transaction documents, the SHA, SSA, and founder employment agreement. A founder employment agreement is a simple agreement with a little more restrictions and imitating the clauses of non-compete and business exclusivity and intellectual property. Within this agreement, a comprehensive set of rules and guidelines are put for the founder to function as the employee of the company. They would be bound by the board decisions. There will be certain conditions put down under which the company can terminate the agreement. There will be positions, clauses put down to tackle situations when the founder is leaving the company, to ensure they return all the material of the company within the specified time and do not take any advantage of that. There would also be protective clauses for the founder to ensure that any amount of settlement that they have with the company will be paid out by the company. So a normal employment agreement, but a little more comprehensive in nature, it needs to be put down to put it in writing that yes, the founder is now the employee as well of the company and will stick here and run the business. Right? As we discussed, exclusivity, confidentiality, and governing law, the first bit itself, these are the defining characteristics of a term sheet, which essentially are the only enforceable provisions within a term sheet. Right? So we'll skip that. Going to representations and warranties. Now this indicates, so there is a very indicative thing in the term sheet, but becomes much more detailed in the shareholders agreement, where you would want certain representations and warranties from the founders, and fundamental representations and warranties need to be also taken from the investor. What are these representation warranties? Here you are essentially saying that both the parties are qualified to enter into this agreement, have the correct authority to enter into this agreement, and they have not entered into any other agreement which would restrict them to do what is being written in the shareholders agreement. Right? These are the fundamental representation warranty. For the company and the founder, they go a little more into the detail in terms of what the business of the company has been, and this needs to be verified and checked as per the due diligence that the investor also conducts within the company. Okay? Now moving to conditions precedent and conditions subsequent. These are very related items. Essentially, what a condition precedent is that once a due diligence is completed, there are several sections within a due diligence. You do a normal corporate section where you're looking at what the essentially the regular board meetings of the company, the registers of the company that have to be prepared as per Companies Act. You also look into the share certificates of the company, the agreements of rent agreements that the company has with its primary address. All of these documents are checked. Then you have a certain section where you look into the employment agreement that the company has, any agreements it has with its suppliers, any agreements it has with its customers. All of those agreements are also looked into it. Then there's insurance a section in which you look into what the current insurance policies of the company is. There's a specific registration and licenses section where we also check, whether they have all the registered licenses that are required. If you are running a food-related company, you need FSSAI certificate. You need, other kind of fire safety certificate for your kitchen, and all of those things have to be checked. Similarly, if you're running some kind of IT company, you need to have online policies. You need to have a website terms and condition, terms of service, terms of use, privacy policy. All of these need to be placed. So these come under licenses and regulatory items that are there. And then you have litigation and intellectual property, all the intellectual property, whether it's properly registered or not. And then you have the last bit with respect to litigation, whether is there any current ongoing litigation against the company or not. So you analyze all of these things, and then you come up with certain issues that might exist which need to be taken care of. they are generally put into two categories: conditions precedent and conditions subsequent. A condition precedent essentially means the investor is saying, see, these are the list of risks that I have highlighted. They are very big in nature according to me, and therefore these need to be corrected before I put my money into the company. So from the date of signing of the shareholders agreement and the share subscription agreement till closing, there is a period. So basically closing is essentially the period, the day on which the company says and that all the conditions precedent are completed by us. Right? Conditions precedent would include also regulatory filings as well. Right? You need to increase your authorized share capital. You need to ensure that you have correct classification of your share capital. If you're issuing CCPS, then you need to have authorized capital for CCPS. Beyond this, you also need to ensure that there is a draft articles amended, right? So essentially, an shareholders agreement is terms that are related to governance of the company. Now, as per court decisions, any such terms that relate to the governance of the company, the inter se rights of the shareholders need to also be put in the articles of the company. And therefore, if they need to be put in the articles of the company, an investor would probably ask you to give you a draft of what the articles will look like post investment. Essentially, in that amended article, you put all the pointers that are there in the shareholders agreement as clauses in the articles of the company itself, which ensures that any liquidation preference that the investor has is covered in the article. So the company is definitely bound by that. Right? So that also becomes a condition precedent. Agreeing on a draft of the articles of the association also become as a condition precedent. Then also there is draft offer letters and board resolutions that an investor might want to look at before they are executed properly. If there are any errors or anything, that can be always covered in the draft version. Once all of these condition precedents are done and all the drafts have been sent, all the points that are outcome of due diligence have been covered by the company, the investor will then ask for a certificate saying, okay, all the conditions are precedent. The day the founder sends that CP satisfaction certificate, is what we call it, condition precedent satisfaction certificate. On that day, it is now on the investor's end to complete the funding within the next 5, 10, or 30 days that is specified in the agreement, right? That day on which the investor sends you the money is the closing date. Now, there could be certain issues or certain regulatory filings that have to be done post the money is received. First, let's look at regulatory. Once the money is received, you need to ensure that you're filing all the past 3 forms so that you can, actually utilize that particular amount of money and are actually allocating and allotting those shares or CCPS or whatever the instrument is to be issued to the company. That becomes a condition subsequent. There could also be conditions subsequent with respect to filings with other agencies such as RBI. If there is an actual issue of shares to foreign entity, you will have to file an FCGPR. Those become conditions subsequent. There could also be certain conditions that arose from the due diligence, which were not very big or risky in nature for the investor, and therefore they said that we can take care of this post we have put in the money. Maybe those things require some specific amount of expenditures as well. So if you do not have, let's say, a website, the investor might say, okay, you use certain amount of the investment to build a website from the company, and there will be an obligation on you to complete that within a certain amount of time frame. That essentially what a condition subsequent is. And regulatory also, it will include something like making sure share certificates are issued within the timeline specified in the company. So condition subsequent all will be done post the money is received by the founders and the company from the investors. This essentially wraps up all the terms that are covered in brief in the term sheet, but in detail in the shareholders agreement. Now, as I spoke briefly about the shareholders agreement and the articles, we need to ensure that these terms are covered in the articles of the company to make sure that the company is compulsorily bound by it. Now, professions that you generally need to engage in this particular transaction, a lawyer who generally do the due diligence as well as the drafting of all the transaction documents, and because there are regulatory filings that have to be done, a company secretary would be required from the company's end to make those filings. This is essentially how we function. We as a Savang Associates firm have created a group of professionals which are specifically working for such transactions, and we have done several transactions since our inception in January 2019, and most of them have been in early stage, so there's a good amount of knowledge that we have gathered in terms of negotiation of early deals as well. Thank you. So I think that essentially wraps up the whole discussion regarding the term sheet as well as the shareholders agreement. I think there's a question answer session available within which you can put down your pointers and we can start taking those questions, because I'm sure even though these guidelines, these definitions are existing in a standard nature, these always need to change as per the negotiation of a specific deal. So if there are any questions relating to any specific scenarios you want to ask us, please feel free to put them in the question answer.
Sure, sir. I'll share that screen from my end. Compile something around 35 to 40 questions. 1 minute. I hope my screen is visible.
Yes, yes.
So I think the first question is, what is the SHA? Should we take that?
Yes, you can start now.
Yes. Yeah. So shareholders.
Yeah, Shubham, go ahead.
Yeah. Okay. Shareholders agreement. So essentially, when you're doing an investment in the company, investor will ask you certain amount of rights, right? Those rights are essentially covered into a shareholders agreement. Now, there are two agreements that are generally executed in a transaction, right? A share subscription agreement. This agreement is executed between company and the investors and the founders, wherein the investors are saying they will invest in the company and the founders are giving certain representation. A shareholders agreement is signed by all the shareholders of the company, including the founders and now the investors, since they will become shareholders, and the company as well. So this essentially covers in detail all of these rights and obligations that we discussed in this whole presentation. They're put into proper clauses and are signed by all the shareholders of the company. Does investment by angel investor also require shareholders agreement?
Yes, it does.
Yes. Unless you're going for an investment from friends and family, which is a very early stage thing, there it might be possible that you're not executing these detailed documents. But an angel investor who's running a proper angel investment platform, or doing serious angel investment, would always want a shareholders agreement. The rights and obligations that we discussed over the presentation might be a little minimal in that, but yes, that will be required. Generally, the investee to have a concern that once investor comes, they will be controlled by investor team. How to build resilience and grow above this mindset by investing. So there are several things. See, we discussed a lot of clauses, investor, what kind of obligations they are trying to put on the founders, right? But when it boils down to the functioning of the company, there are only few things within which you need to look and make sure that you are properly negotiating. One is the reserve matters. So these are essentially matters on which you will have to take the approval of the investor to do any of those matters. So it's a proper list of around 15 or 10, 15 points, right? You need to ensure that there is nothing overly extensive in that. There should be not conditions such as that if you're doing any capital transaction above 10,000 or 50,000 rupees, the investor's approval is required. That should not be the standard. A standard for an early stage company should be 10 lakhs. If any transaction above 10 lakhs, and that too only if the transaction is beyond the business plan. If it is as per the business plan that the company has passed in the board in the beginning of the year, then such approval should not be required. So reserve matters is essentially the part where the investor can enforce or change the direction of the company, how it's making decisions. So that's how you can control it by looking at the reserve matters. Ankita, anything to add on this?
No, I think it's good.
Every time a new investment is made into capital of the company, require a term sheet. In that case, what will happen to term sheet signed prior to that investment? So term sheet, as we said, that essentially is a non-binding document. Only three things are binding: that parties cannot look for other investment for a particular period of time, or that expires once the number of days is over. Second is confidentiality, which will continue, and third is jurisdiction, where the dispute will be brought in. So the moment either you sign in SHA, SSA, the term sheet becomes ineffective, or let's say the number of days pass, the term sheet becomes ineffective. So you don't need to worry about the legal consequences occurring from a term sheet. And NRI invests through CCPS convertible in 5 years in a private limited company in India, 2.5 years over from investment. The Indian company faces management quarrel. What is the way out for the investor and the company? Can the investor waive his investment and the company write back the same? Are we looking in what manner that they can the investor waive his investment and the company write back the same? If you're talking about return of investment through buyback, then that's governed by Companies Act, so you can't do all of it together unless the amount of stake in the company by the investor was less than 25% of the company, then that could be possible. But generally, a management quarrel is, see, that's why the investor should get all of these rights in the company, because this ensures that whatever the management quarrel might be, they still control the big decisions of the company. So in that quarrel, no one can actually do something to the company or its affairs that could be detrimental to the investment that they have put in. Right? And beyond this, there is a certain clauses that can be created for material breach. If due to their quarrel, they are not following any of the terms of the shareholders agreement, that can result in a breach of the shareholders agreement from the management. The moment that happens, you can put in protection for the investors saying that the material breach has occurred, and accordingly, we will now force the company to buy back our shares, or we can remove the directors, the founders as directors from the company. These kind of consequences can be put in the material breach.
So to add on to that, there are certain provisions with respect to the arbitration and all, which also comes into force, whenever there is such kind of an event happening. So there can be, a situation wherein there is a dispute and an arbitration mechanism is being followed to resolve that dispute. So that is also what built into the agreement.
Kindly share any of the challenges from founders' point of view and challenges from investors, and how the existing jurisprudence. So, I mean, we have done this, I think, for each of the terms that are there. Overall, in terms of jurisprudence of case laws, essentially it's boiled down to enforceability of SHA as one of the bigger things. Beyond that, these rights are generally acceptable by the court as they exist in the SHA. They don't generally say that these rights are not enforceable. So jurisprudence-wise, it's quite clear in terms of challenges we have done for each of the points. What are the significant differences between anti-dilution and preemptive right? Okay, so they are very different. Anti-dilution is basically, let's take it with an example. Okay, now today, let's say an investor has come into a company at a price of, let's say, 100 rupees per share and has acquired 10% of the company. Tomorrow, because the company wasn't doing good, you are issuing more shares. The moment more shares the company is issued from the company, all the shareholders get diluted, right? The new shareholder is coming, he's taking certain amount of new shares, and therefore everyone else, their percentage shareholding in the company dilutes. Now that would be okay if the price that new shareholder is coming at is higher than what the earlier investor came in at, right? The investor would be okay because his valuation is still growing, right? But in the event the company is not doing good and they have to issue shares at a price lower than what they did for investor one would want the founders to take the dilution and not them, right? They would want their percentage stake to remain in the company to be the same. Now, to enforce that, they would either ask extra issuance of shares at face value, or adjusting the CCPS's conversion ratio, right? That is how they will go about it. But that is the commercial reason behind anti-dilution. Right? A preemptive right, on the other hand, says that if company wants to issue new shares to any other entity, it should offer such number of shares to the existing investor that they can retain their percentage stake in the company. Right? So if as a company I'm issuing, let's say, 100 more shares, there is an investor existing in the company that owns 10% of the company. Out of those 100 new issue, I have to offer 10 to them as well, because they have the preemptive right to ensure that their percentage stake in the company remains the same. This is not dependent upon the price at which the shares are being issued. It's anti-dilution where the price is random. company going for a small amount of focus over the 2 years for 20% equity partnership. So, see, this is again has to be taken a lot more into the context. If the investor is investing 4 crores, it is very odd for it to be split over a period of 3 years. And this again depends what kind of company it is, what stage it is at. But within 3 years, there is a reasonable perception that the valuation of the company might change. Whereas you are currently agreeing to a 20% equity to be given at 4 crore to the investor, right? So that valuation might have increased by the time of the third year. So essentially, you should look within all the 4 crores to come within the first 2 years, because by the third year, the investor might be getting a good deal because because the company is worth much more, but because of this earlier deal, you still have to issue them at the same valuation. So valuation is probably a key.
And I think what this question also entails is that they are getting the investor is getting 20% equity upfront, which is a bit odd because you can't get 20% upfront. You will get up to the amount to which you are investing because that's a statutory requirement. You will be allotted the shares. This is the valuation and the amount which you have invested during the first year, second year, and third year. You can't get 20% upfront, in the first year and split the investment for 3 years.
You can scroll down. I think templates are available on the internet as well. There are several investment houses that just upload their term sheets. From there, you can get it. Are we uploading any standard formats, Ami?
You can give the standard format, but it would be available on the internet, I guess. That would be better because there are confidentiality attached to the formats.
Right. Is it right to presume that present dispute in Amazon future? On account of poor legal drafting of investment agreement. So see again, what we have also received information is what is going on publicly in the courtroom. But essentially, I think that the drafting could have been better if it, without any loopholes specified, that whatever obligations are being put on on future by Amazon will also apply to the other companies in which future has invested. I think that was probably supposed to be there, and that is not there, and that's why the whole dispute has occurred. So I mean, the exact legal language, only after looking at that we could have figured it out, but can't really comment on this. Can ROFR and ROFO coexist in a shareholder agreement? Yes, they can. See, right of first refusal and right of first offer are rights that are held by a person, right? Now it depends. If both the rights are there in the agreement, they cannot be held by the same person. That does not make sense. You could have an agreement where the right of first refusal is kept by the investor, whereas the right of first offer is kept by a founder. What would mean here is if the investor tomorrow wants to sell his stake in the company, the founders will get a first opportunity to make an offer to the investors to purchase those shares. So in that manner, it can exist, but only the investor holding a ROFR and a ROFO is generally known. What is the ballpark cost of completing investment agreements assuming startup capital is rupees 5? If this is the investment amount, the 5 crore is the investment amount, then it can range a lot depending on, if we are also doing the due diligence or not. An overall package could lead somewhere between 3.5 to 5 lakhs as well. But again, this is very dependent upon what kind of law firm you're going to. There are firms like us.
And also what kind of scope we are referring to. So if we are only doing the drafting and negotiation, it will be a different aspect. And if we are doing the diligence as well as the closing actions as well as the documents, then it can amount to around 4 or something, or 5. But if we are doing a certain piece of it, then it will be as per the amount of work which we are doing.
Right. So a combined thing of due diligence and drafting of the documents and negotiation could reach up to 5 lakhs. Again, this is the amount that is paid to the drafting team. On the company side, it will generally be a reviewing team, so the cost would be a little less for the company. Can you explain the practical difference between ROFR and ROFO? Why would founders prefer ROFO while the investors prefer ROFR? So the key thing is here is price discovery. In a startup, finding the actual worth of the startup and the shares of the startup is very difficult. It is altogether an exercise. So who does that exercise is the key thing, right? In a right of first refusal, let's say I am the holder of a right of first refusal as an investor on the founders. So the right I hold is to refuse, right? Refuse what? So basically, an offer has to be made from the third party. The third founder has to go into the market, figure out who will be okay to purchase their shares and at what price that third party will be okay to purchase those shares. Now, once the founder gets that offer with them of a particular price, they will come to me and ask me, this is the offer that we have received from X person. Can you match it? If I say yes, I can match it, then the founders have to sell the stake to me directly. Assuming I say no, the restriction on the founder is that they can only go back and sell to that one specific entity who made that offer to them. This is right of first refusal. So firstly, the founder did the whole exercise of price discovery by negotiating with this X person, and then even after I'm refusing to purchase the shares, he will have to only sell it to X person. Whereas on the other side, when we go to right of first offer, a right of first offer essentially would mean the founders just have to come to me first and say, this is the number of shares I want to sell. What is the price you can give? If let's say the investor says 100 rupees is the price I will give you, the founder will then contemplate if it's a fair offer or not. If not, they will refuse it, and then they can go to the market and sell at any price higher than 100 and to any person that they find who's ready to purchase at a price equal to or higher than 100, not equal to. Right. So essentially, firstly, the price discovery here was done by the investor under right of first offer because they made the price offer to the founders. And secondly, the founder here on a ROFO was not limited to only selling it to one entity. They had the whole market available to them, but they only had to abide by a base price. That is the ROFO. So if you look at it practically, ROFO is much more lenient as compared to a ROFR and puts the obligations on the investors. Therefore, the founder will always want to give away ROFO, and the investor will want a ROFO. How ROFR and ROFO was used by Amazon against Future Retail for their intended sale of Reliance Retail. Essentially, Amazon had the right to first purchase those shares that were being sold by Future, which is what was not offered to them, and that has led to the overall dispute. That is what essentially it is. The Amazon had that right to purchase it. Future has not given that right to them, and because they are claiming because this was a sale of a subsidiary, this right was not supposed to be given, and that is the whole dispute.
So again, it will be very difficult for us to delve into this because we are not aware of the exact provisions of the agreement.
In case of dispute with investor, which will be the ideal way to settle? So any dispute, firstly, mediation is always open, within which both parties sit down with the mediator whose sole job is to ensure that an amicable solution is reached. If mediation fails, you can always go for arbitration. Arbitration is faster than judiciary because you can appoint a single judge and the matters will be held much more regularly than as compared to the judiciary. And if even arbitration award is something you're not happy with, you can always go to the courts and settle the matter. These three-step mechanism is better. Generally, mediation always helps, so you should always put mediation and then arbitration. if there is a vesting clause in SHA for founders, does it hold legally? Because as per companies, there is no concept of vesting of shares that are. So again, this is a contractual restriction that we are creating. Even though there are no clauses or statutory, it is not specified that such a thing, such a right can exist or such a restriction can be created. It does not mean such a restriction cannot be created, right? So essentially, because it is not specified that it would be illegal to do it, it is okay and acceptable in the form of a good contract, wherein and even in a contract, we generally always specify that it is the sole title of those shares are available with the founders always. However, we are contractually only restricting the manner in which they can transfer. That is it. Right holders other than investors and promoters, there could be existing investors in the company as well, who would sometimes want to hold these rights. A right holder is essentially, if you're talking about this in terms of the rights in the term sheet, is essentially for whose benefits those rights have been created. Right? Is there any difference between preemptive rights versus a right of? I think we have already done preemptive ROFO right now.
Yeah.
Sir, whether entrenchment provision in the Companies Act is a vote? Entrenchment position in the Companies Act is the mode by which the investor-investee agreement is enforced. No, so basically the Companies Act specifies that a company is bound by only one thing, that is its articles of association when we are talking about the governing aspect of the company. So there have been case laws where two shareholders together agreed that they will have a right of first offer on each other or something like that, and then the company still registered a transfer even though it was against the agreement between those two shareholders. So the court held that for the company to be compulsorily made to enforce these rights and ensure that the governance is happening as per what the shareholders are agreeing, firstly it needs to be there in the articles of the company altogether. And to add another layer of protection, legally what we do is we make the company as a party to the shareholders agreement as well. If you do these two things, make the company and the founders part of the SHA and put the terms of the SHA in the articles, court will always uphold your rights in the matter.
And with respect to the entrenchment provision, which is provided under the Companies Act 2013, it is a mechanism wherein the investor and the company has agreed to provide any a regulation or a provision to be made more stringent, and there should be a different mechanism to be followed that can be also agreed upon through this entrenchment provision under the articles.
Yeah. Please explain veto rights if it is not covered as. So veto is essentially a reserve matter. We call it reserve matter because what we are going and doing is going a step ahead than veto. In a veto, it essentially means if I have a veto power, if tomorrow decision is being made in the board, I can say no, this will not happen. I veto against that decision. A reserve matter mechanism essentially blocks the company and the board to even bring that matter to the board unless they take my position, permission on that particular matter. So before even I require to use my veto, they will have to take my permission to bring the matter to the shareholders meeting or the board meeting. How come the ring fence entrepreneurs or founders versus? I'm not understanding the question.
So I think what he is talking about is how to actually negotiate the better rights for the founders when there is a big pocketed investors there. I think this is what the question is.
So again, this is very dependent on how, what kind of resources are there in the company as well. But I hope this session helps you in better understanding what you can ask for in terms of, creating linear rights against the company and the founders. But definitely these are negotiations that have to be taken into the much more detail of each and every clauses, and a legal resource will be required.
And it will also depend upon at what stage the company is. if the company is at a higher valuation, so the founders and the entrepreneurs will have the much better negotiating power. So it will also depend on that aspect.
Yes, generally every investor has a draft, of the reserve matters. Essentially, a reserve matter should be looked with this angle that in day-to-day affairs, it should not create any hindrance. In day-to-day affairs, the approval of the investor should not be required. Generally, investment coming into the company, people exiting the company, these are all matters where which are converted into reserve matter, which is okay because we are trying there. The investors are trying to control the shareholding of the company to ensure their interests are not, hampered. That's fine. But day-to-day functioning should not be created of a concern. So sometimes, to give you a very niche example, there is always a reserve matter that talks about transferring of the IP of the company and use of the IP of the company, and they put a restriction on that. It is essential to always make sure that clause always talks about a exception for ordinary use. So in case in ordinary use there's a company, software company that is continuously selling software to people as a product, there that clause fails because your business is essentially to sell software, so it should not be part of a reserve matter. Indemnity, you could take this.
Sorry?
24th question.
Yeah, so generally the indemnity provisions are generally not triggered, that easily. But yes, it is a right which is made available to the investor. Yes, there had been one or two instances wherein the IP, the tech-based company, wherein there was a dispute with respect to an IP and there was an infringement of the IP of the company, due to which there were certain legal notices which were provided, issued to the investors representative on the board. And there was certain loss of reputation which has occurred to the investor, against which the investor has triggered the indemnity. So I think that is what one provision which I can come across right now, which I can, recall. The next question, I think, could you walk us through the process as well as arbitration concerns that arose? Arbitration concerns I did not understand, but yes, there is a mechanism wherein these kind of disputes are solved by the arbitration as well. But it is a last resort which is used by the disputing parties. Normally the negotiations happen among themselves and nobody wants to go to that extent. But yes, arbitration happens, or before arbitration happens, generally people also call upon a certain senior personnel who is involved in order to mediate that kind of a dispute and come to an amicable solution.
Is it necessary to state the terms which will qualify for indemnification? Say, for example, wrong statement of number of clients, revenue numbers. So generally, such specific items are not put. A general statements are put wherein we say all representations are provided by the company will be true. That covers these kind of instances of the number of customers that would have been provided. And again, the investor will always get an opportunity to check whether or not the number of customers you're saying you have are true or not, because during the due diligence process, you also look at the financials of the company. The DD process is divided into both a legal as well as financial. But in terms of framing of indemnification clause, you should always ensure from the founder's perspective that you say that indemnification will only be provided when there is an actual loss. Now, what an actual loss essentially means is that there should be money either going out of the pocket of the investors. If there is no actual money that the investors are losing out on, then indemnity should not be claimed. That is a general limitation you can put on them. Again, beyond this, you can put further limitations in favor and to make the founders relax, is that overall whatever claim that the investor will never cross what the investment amount is, which Ankita specified when we're talking about indemnification. Okay? Beyond this, we could also look at ensuring that what the law says. So the law also says that indirect losses or remote losses are something that cannot be covered. So, for example, if I give you, I contract with you for providing you a certain number of supply of material, you further make a contract with another party to provide another finished good. If I am not able to provide you that good, you cannot come and claim, any amount from me in terms of damages that would have occurred to your end customer as well. That is a remote loss. That is a loss that which I am not related to. My contract was with you to provide this particular supply of materials only, and only to that extent I'll be limited. So those kind of standard limitations are also put in legal language. Is indemnification also approached to founders for breach of an? Yes, adverse media against the founder. See, adverse media against the founder will be very, has to be read down in the contract. Generally, there's a non-disparagement clause wherein parties agree that they will not speak ill of the other party unless obviously truth is an absolute defense. So you will not essentially lie. So if you're looking at the very nitty-gritty, if tomorrow the investor has said something wrong about the founder in the media, the founder will have to prove it that what was said is incorrect, or what they've said is wrong, and then obviously you can claim under indemnity if indemnity is made mutual. But it is very difficult in the beginning phases to negotiate a mutual indemnification clause. But to the extent of the representations that that the investors make, that is to say that investors are qualified to enter into this agreement, all of those representations can be taken. If the investor breaks those, tomorrow they come, no, the person who signed the agreement was not actually authorized, then you can claim damages against them. But in terms of them saying something wrong, it has to be specifically covered into the contract for you to have any recourse under indemnification. How an investor can avoid diversion of funds by management of the investing company. So again, this is part of the reserve matters and also part of general governance of the company. Some of the key things that are there in the reserve matters are that 10 lakhs above transaction should also happen with the approval of the investor, or things like that. If the founder is increasing his salary, it has to be with the permission of the investor, because these are mechanisms from which funds can be diverted. If a related party transaction has to take place in the company, then it has to be by the approval of the investor, so that the founder tomorrow does not make one of his family members a supplier and just transfer huge amounts in terms of purchases. So those kind of protections are always there from the perspective of an investor through reserve matters to control these transactions. Are there any
on top of that, we
matters?
also have the information and inspection rights to control
Yes.
these.
And regular monthly, quarterly reports are also sent on the information rights, so that the investor can always track how the funds are being used. Are there any general mandatory deeds agreements that should be in place by law? So by law, it's only compliance related documents that are required. A share subscription agreement and share holders agreement are by in contract. So the law essentially states that articles will supersede everything else, and therefore to amend the article, you are doing this agreement in which you're also saying that this agreement is also valid, and the articles will be amended for this article. So that is, it flows through requirement of law, but there is no specific requirements that say in the law that there has to be an SHA, there has to be an SSA. It is only right, an offer letter offer letter that has to be issued, and a pass-through filing that has to be done in terms of issuance of securities. Rest all is being created for the protection through contracts. What are typical fee structure provider range for providing services of structuring of term sheets? So again, yeah. What are the normal reps and warranties in an SHA? This also we have covered, fundamental reps and reps beyond that. Is it necessary to get the registered value certification of the firm every time new capital is raised? So this is again a requirement by law. So therefore you need to get it. You need to get it from a registered valuer as well. For every transaction that happens in which the company is issuing any securities, you have to do this. One registered valuer certificate is valid for a period of 6 months. So within those 6 months, if you're issuing two rounds of securities at the same valuation, you don't need another certificate for each transaction. But beyond that period, yes, you will need another certificate. Non-competing. In case of Zoomcar, one of the founders left and started Rev. Would something like that not come under non-compete? So again, Zoomcar and Rev are how are they structured? Are their business essentially the same? Is the revenue that they are getting from the end customers is of the same model? These things will have to be analyzed. Ideally, from what I know, Zoomcar and Rev. Zoomcar is for short duration of rental period, and Rev is targeting a longer duration as a complete replacement to buying a vehicle altogether. So they could be considered as different businesses. Zoomcar
And
generally is
also there
available
might
for
be
taking.
certain negotiations as well at that point of time. There might be certain things which might have been asked from the outgoing investor. So
Yes.
that is how these things happen. So there might be a fee which might be asked against the starting of the similar kind of a business. So at that point of time, all these things are being negotiated and entered into and settled into.
And again, to enforce non-compete, it is a very difficult task because in judiciary, see, to do a particular profession is your fundamental right under the Constitution. A non-compete is taking away that right. So it has to be very reasonable and low in that perspective. So it has to stand the judiciary test. Let's say there are 10 investors, there will be a 10 term sheet structure different. No. If the investors are coming in together at the same valuation, or even if different valuations with the same set of rights, then only one term sheet can be signed by with all the different investors. SHA, SSA relax on a case-to-case basis by way of separate. Yes, you can always amend the document. In fact, a lot of times when you're doing bridge rounds, basically a smaller round before you go for a bigger round, you always just amend the existing SHA, SSA to make sure you know there is a less cost involved in terms of legal engagement. What is the cost for making SSA? This is already covered.
I think we have
Let's explain. Yeah, pre-money, post-money with an example. So again, we did this in the beginning. Pre-money is essentially before I put my investment, what is the worth of the company? So 10 crores, if I assume is the worth today, and I invest 2 crores, the post-money of the company becomes 12 crores. And before that, it was 10 crores. How can startup ensure that investor will meet his commitment, whatever he has agreed? Can it be enforced? Yes, if the money is set to come in tranches, they have said, "Aaj first tranche hum karenge, 6 months while we'll look at your performance and do the second tranche." If the performances are met, it is a contractual obligation for them to provide you that money. You can always, if they are not doing it, you can always take recourse under arbitration and go into the courts. Register shareholders agreement as in stamping is definitely required. I am not understanding the registration part. You need to definitely stamp the shareholders agreement and execute it in stamping.
I think registration with the sub-registrar, if it is asked, is not required.
Okay,
But yes,
is not
proper stamp
required.
duty
Yes.
under the Indian Stamp Act is being paid.
Yeah. Relevant filing would include basically amending. When you amend the articles, you will have to do all relevant filings for the amendment. That will be something that is from the registration aspect. Could you provide a repository formats, temperature, various within term sheets as well as emissions? Oh, and this is what our bread and butter is.
So that I think will be available on the internet because this is something
Yes,
which is
you can always find base draft. Yeah, base drafts are always available for free. Is there any minimum lock-in period for the investors? Not really. Generally, an investor is coming in to make money. If he makes money within 2 months of coming in and is able to find someone who's ready to buy his stake and give him a 10x return, then he would want to take that. So lock-in is never generally applicable on the investors. How long term sheets are generally held for? So term sheet validity is generally 45-60 days within which the parties have to conclude the transaction and sign the SHA SSA. If not, the term sheet lapses. Can you give us some details of the filing required when there is a foreign investor investing in the company? Again, you will have to look at FDI regulations, what kind of investment is coming into the company, whether or not they, you can take the automatic route or you require the approval. Beyond that, there is an FCGPR filing that has to be done. You have to also look at on what basis the foreign investor is coming, repatriable, non-repatriable, and accordingly make the filings. It was said that there was reserve matters. Is it not possible for the founder to take up matter without investor consent? It means majority of board. Yes, that is what it means. Even if you have majority on the board, you can't act on those matters because the investor has put that matter into a reserve matter. So something like, let's say, increase in the salary of the founders. Today, founders are earning 1 lakh rupees per month. Tomorrow I make investment and they increase their salaries by 5 lakh rupees per month. That means essentially they are, siphoning of the money in terms of salary. So that is something what the investor is not looking for. Is looking for the founder to invest the money into the company and grow the business. So they would want to have put that into a reserve matter. And once it is put into a reserve matter at a board level as well, you will have to take the investor's approval to pass it. So again, a right of first offer, right of first refusal, all of the other rights are not valid and existing in the term sheet. In the term sheet, it is not, you cannot take the term sheet to court and say, no, I have a right of first offer. A term sheet is capturing an intent of both the parties to enter into proper documents, which will cover these clauses in detail. Only once the SHA, which has these clauses, is executed, can the investor enforce his rights. Before that, through the term sheet, it cannot be enforced. How to approach term sheet negotiation between angel, VC, institutional investors. So a lot of these things change as per the level of investment you're going on to. Like if you have already built a successful company, you have around 300, 400 crore valuation. Now you're looking for VC investment of another 200, 300 crores. Then at that point of time, you have a lot more say in terms of what restrictions can be put on the founders. Their restrictions could be made easier as you go, as you have a higher valuation company, as you have already proved your business, and there is already a scope that you have proved for expansion and growth of the business as well. In the initial stages, it's very difficult because in the initial stage, either you have just created the product, you haven't even got enough revenue to cover your own expenses, you're not yet profitable, maybe you are still under the process of creating that new technology. So all of those factors lead to a position where in the earlier rounds, the founder is not able to negotiate the best and comfortable deal for them. Yes, founder salary compensation will can be made to be governed by the shareholders agreement by way of reserve matters. Practically, a lot of startups have agreements with key customers if they have change control clause in case of a buyer where does to sell. Okay, so firstly, talking about a change in control clause in a service agreement altogether. Generally, such a clause should not be there in a service agreement unless it is absolutely making sense in that particular transaction. Like for example, if I'm looking at the services of particular place where I have faith in a few people who are working there and the person who owns that company, that they will be able to provide me the services, then it is okay. And generally these clauses are only asked by bigger companies, so you should always try to negotiate out of it. But in case you cannot, yes, this is a point of concern for both the incoming investor, because then it would lead to a situation where if there is an actual change of control, and again, change of control, we need to look at the definition of Companies Act. It essentially means when more than 50% of the company is being sold, or there's a percentage change of more than 50%. So only in these situations will you have to send a notice to your customers telling them about the change of control event. If their capabilities is still intact, if your capability to still provide the services or the product is still intact, you can probably justify with that with your customers. And once it is justified, they would be happy to resume and still continue after the change in control, because essentially what they care about is whether properly the services and products are coming to them.
And also we have to understand that even in the customer contracts or service agreements, there are confidentiality provisions intact. So all of these things will fall under the confidentiality provisions as well.
You understand a variety of right. So we discussed this. So as a founder, definitely review your reserve matters. If you have the financial capability, put a ROFO on your investors so that if they want to sell, you can still retain control of the company. Make sure all the expenses regarding the transaction. Sorry, I could not get it.
I said try to get the minimum lock-in possible.
Yes, minimum lock-in possible. Make sure there's always a certain amount of unlocked portion of your shares which you can sell in any case of emergency without any restrictions. These are the primary things. all expenses that has to be carried out, make sure they're agreed upfront with the investor in the term sheet, and any kind of nitty-gritties if they're looking for further investment are also captured properly into the agreement to ensure that there is an obligation put on them.
And also, you should have some flexibility to continue with the operations, and it should not be that even for a smallest kind of item, you should go to the investor for the approval.
Yeah. Yeah. And again, there's another clause that you can put is a fall away. If tomorrow, let's say the investor's shareholding falls below 5%, then it makes absolutely no sense that a 5% shareholder has the right to drag the rest 95% shareholder in a sale. So the moment their shareholding reduces below, let's say a 5%, a 4%, a 2% benchmark, the rights that the investors hold should start falling away. Angel investment, would a safe agreement not suffice? It really depends on the angel investor if they are okay with taking a safe agreement. Safe agreement is something very American in nature, which has recently been started happening in deals in India as well. But again, this also happens and typically is possible when the investment amount is somewhere between 50 lakhs to around 2 crores. Beyond that, if an amount is being invested, people generally, all angel platforms go for a full-fledged agreement. Draft shareholders
And the
agreement.
Indian mindset is that they want, and the Indian mindset is that they want all the rights to be made available to them, even in the smallest possible document.
Yeah. So stamp duty again depends on what jurisdiction you are in. Typically, I think Karnataka recently we did a deal around 600, 700 rupees was the stamp duty. The share subscription agreement will be dependent upon what the amount of investment is. So the lawyers are primarily responsible for putting it into the document of what the capital structure, the instruments, and are being used in any agreement. So again, SHA registration with sub-registrar office is not required. Essentially, you need to amend the articles of the company to make sure it's enforceable and make the company as a party to the SHA. Does the transfer expenses on dilution of shares can it be claimed expensive? This is a very tax-specific law. I don't think I'm very qualified to give this answer on this.
Tax related, but I think there are no transfer expenses as such, but there is capital gains which will be applicable in case of transfer.
Yeah. Templates again, we can look it up online. Registered value report is something that is required upfront because that also is required for filing. Merchant
banker
report
is required by the income tax department whenever there is a notice issued to the company. Generally, since the notice is not issued due to the flexibility under the DIPP regulations, we do not require the the merchant banking report for the investment happening into the company under the law.
So that relaxation has been provided. So it will be a civil action because it's a contractual obligations that are being broken down. But it depends again what kind of fault has been done. Civil courts today are inclined towards transferring company specific matters to NCLT, and it could land up there. If a SPA, SHA has predefined rate of buyback. So this again depends whether it's what kind of obligation is being created. Is it that if the company is unable to provide this kind of IRR, then all the assets has to be sold and it has to be complied with, or is it like the minimum that we are looking for? Is it the base that we are setting? So it depends on that. Yes, there could be possibility that in case you are not structuring it properly, it could be construed as a debt financing. So again, this is one of the things that a founder should always fight back, a minimum IRR. It needs to be understood that this investment is being made into a startup. which is essentially risky, which is trying to do something, which is highly innovative in nature, and therefore there is a good chance of failure as well. We all know 1 in 10 startups only succeeds, while 9 of them fail. So in that case, putting a minimum IRR is highly unfair on the startup. So you should always fight that back and not put into the agreement. Educationally, covering transactions, there are books, but the issue is that within Indian context, how the startup system is currently doing it is not yet covered in proper textbooks. However, there are a lot of publicly available research papers that professors around the country have already written by analyzing what the trend of these transactions are. I will try to send one of such papers post this call to the IT, and I think they can circulate with you. What are the considerations?
We have also some research papers available with us within the firm, so we'll also, Shubham will circulate those as well.
What are the considerations to be taken into account in choosing the investment instrument, equity CCPS? So CCPS has many benefits from the investor's perspective, because they're looking for a liquidation preference. They are looking for getting differential rights in terms of as a shareholder, and also because CCPS is a preferential capital, they would want that. It really depends on what kind of investor is coming in, whether they are ready to take the same equity kind of risk that you are taking in the company or not, and it really depends on the stage of the company. At a later stage, generally, at an earlier stage, generally CCPS is always sought after by investors. But at a very nascent stage, when you're just beginning the company, maybe equity will flow.
So I think these are the questions.
I think that concludes all the questions as well.
Yes.
Thank you so much, sir. It's almost around 60 questions you have handled. It shows your subject knowledge and
nearly 1 hour question answer. That is real helpful to the members.
Correct. Members, tomorrow also we are having this startup session on how chartered accounts can add value to their startup clients and build best practice in this startup area. One chartered accountant Namita God from Mumbai will address. Kindly try to attend for this tomorrow program at 6 o'clock. With this, I request Panaraj sir, Secretary of SIRC, to propose a formal vote of thanks.
Thank you, sir. Madam Ankita Singh ji and Shubham Patel ji, extraordinary efforts from your side. And this is the very reason why the CA Institute has come out with a new proposal of networking with other professionals recently. So far, we were not permitted to have any partnership with other professionals. But now the field is so vast, and so all the experts from various fields are bound to be part of the team, be it engineering side or advocacy and like that, company secretaries and all. So this is one example of the wide areas are drafting and legal aspects of so many things. The real black and white of the startups is given by you. Hats off to your efforts, and being advocates, your time given to our institute, and that too with SIRC Chennai, thanks to this pandemic. But for this, maybe we would not have met each other. It would be very difficult for you to fly down to Chennai and address us. Thank you very much for your efforts.
Yeah. Thank you, sir. Thank you so much.
Thank you so much for having us.
Thank you.
Community. Our institutes, the slogan itself motto itself is being partners in nation building. So we together, we shall come together and do professional guidance and transparency to build the nation further. So thank you very much for your efforts, and hats off to your patience in answering 60 queries, almost nearing the 7th round to complete your presentation. But the queries were the real test of the absorption by our members. Thank you all the delegates who have attended here. And this is not an easy area of practice, we know. because we are already into the income tax and the GST deep into it. And coming into the newer areas is not an easy job. But so many members, 300 plus CAs have come into the field. Thanks and congratulations to you all. And your participation definitely gives us strength to have such programs. This is one. I was wondering whether 4 days program on this area would it be successful, and it was coined by our chairman. But the delegates have proved that it is online and ably supported by all the speakers. So thank you one and all for the success of this program. Tomorrow also we'll meet for the last session of this course. Thank you very much once again.
Thank you so much, sir. Thank you so much.
Thank you. Thank you so much. Be safe. Good night.
Thank you. Have a good night. Bye.